Ranking Member Davis, and members of this distinguished committee. Today there is unprecedented turmoil in our capital markets. Nobody, including me, anticipated how the problems that started in the mortgage markets would spread to our credit markets and our banking system, and now threaten our entire financial system and our country. Like many other financial institutions, Lehman Brothers got caught in this financial tsunami. But I want to be very clear. I take full responsibility for the decisions that I made and for the actions that I took. Based on the information that we had at the time, I believed that these decisions and actions were both prudent and appropriate. None of us ever gets the opportunity to turn back the clock. But with the benefit of hindsight, would I have done things differently? Yes, I would have. As painful as this is for all of the people affected by the bankruptcy of Lehman Brothers, this is not just about Lehman Brothers. These problems are not limited to Wall Street or even Main Street. This is a crisis for the global economy. We live in a world where large independent U.S. investment banks are now extinct, where AIG and Fannie Mae and Freddie Mac are under government control, and where major institutions are being rescued, and where regulators are engaged in a daily struggle to stabilize the financial system. In this environment, it's not surprising that the media coverage of Lehman's demise has been rife with rumors and inaccuracies. I appreciate the opportunity to set the record straight for this committee and to be as helpful as possible in explaining why we ultimately could not prevent a bankruptcy filing. And then I want to respond to your questions. I'm a Lehman lifer. I joined as an intern in 1966 and got a full-time job as a commercial paper trader while earning my business degree at night. In 1994, when Lehman Brothers was spun out of American Express as a separate company and I became the CEO, we were a small domestic bond firm. By 2007, we had built Lehman into a diversified global firm with 28,000 employees. I feel a deep personal connection to those 28,000 great people, many of whom have dedicated their entire careers to Lehman Brothers. I feel horrible about what has happened to the company and its effects on so many. My colleagues, my shareholders, my creditors, and my clients. As CEO, I was a significant shareholder, and my long-term financial interests were completely aligned with those of all the other shareholders. No one had more incentive to see Lehman Brothers succeed, and because I believed so deeply in the company, I never sold the vast majority of my Lehman Brothers stock and still owned 10 million shares when we filed for bankruptcy. As I said, following the spin-off of Lehman Brothers from American Express, our business was almost exclusively in fixed income. We recognized the need for diversification, and over the subsequent 14 years, we built and acquired significant equity and asset management businesses. We established a presence in 28 countries. We also continually strengthened our risk management infrastructure. Lehman Brothers did have a significant presence in the mortgage market. This should not be surprising, though. U.S. residential mortgages are an $11 trillion market, more than twice the size of the U.S. Treasury market. Any serious participant in the fixed income business had a significant presence in the mortgage market. As the environment changed, we took numerous actions to reduce our risk. We strengthened our balance sheet, reduced leverage, improved liquidity, closed our mortgage origination businesses, and reduced our exposure to troubled assets. We also raised over $10 billion in new capital, We explored converting to a bank holding company. We looked at a wide range of strategic alternatives, including spinning off our commercial real estate assets to our shareholders. We also considered selling part or all of the company. We approached many potential investors, but in a market paralyzed by a crisis in confidence, none of these discussions came to fruition. Indeed, contrary to what you may have read, I never turned down an offer to buy Lehman Brothers. Throughout 2008, the SEC and the Federal Reserve conducted regular and at times daily oversight of our business and our balance sheet. They saw what we saw in real time as they reviewed our liquidity, our funding, our capital, risk management, and our mark-to-market process. As the crisis in confidence spread throughout the capital markets, naked short sellers targeted financial institutions and spread rumors and false information. The impact of this market manipulation became self-fulfilling. As short sellers drove down the stock prices of financial firms, the rating agencies lowered their ratings because lower stock prices made it harder to raise capital and reduced financial flexibility. The downgrades in turn caused lenders and counterparties to reduce credit lines and then demand more collateral, which increased liquidity pressures. At Lehman Brothers, the crisis in confidence that permeated the markets led to an extraordinary run on the bank. In the end, despite all of our efforts, we were overwhelmed. However, what happened to Lehman Brothers could have happened to any financial institution and almost did happen to others. Bear Stearns, Fannie Mae, Freddie Mac, AIG, Washington Mutual, and Merrill Lynch all were trapped in this vicious cycle. Morgan Stanley and Goldman Sachs also came under attack. Lehman's demise was brought on by many destabilizing factors: the collapse of the real estate market, naked short attacks, false rumors, widening spreads on credit default swaps, rating agency downgrades, a loss of confidence by clients and counterparties, and buyers sitting on the sidelines waiting for an assisted deal. Again, this is not just a Lehman Brothers story. It's now an all too familiar tale. It is too late for Lehman Brothers, but the government has now been forced to dramatically change the rules and provide substantial support to other institutions. I greatly appreciate the opportunity to speak with you today, and if I can be helpful to this committee in any way to understand how we got here and what our country can do to move forward, I am happy to do so. Thank you, sir.
Thank you very much, Mr. Fuld. Without objection, the chair and the ranking member will control 10 minutes, which they can use or reserve and use at a subsequent time. Hearing no objection, that'll be the order. Chair will recognize himself. Mr. Fuld, our committee requested all the documents relating to your salary, bonuses, and stock sales, and the committee staff put together a chart which I hope will come up on the screen. This chart will show your compensation for the last 8 years. It shows your base salary, your cash bonuses, and your stock sales. In 2000, you received over $52 million. In 2001, that increased to $98 million. It dipped for a few years. And then in 2005, you took home $89 million. In 2006, you made a huge stock sale, and you received over $100 million in that year alone. Are these figures basically accurate?
Sir, if those are the documents that we provided to you, I would assume they are.
Okay. The bottom line is that since 2000, you've taken home more than $480 million. That's almost $500 million. And that's difficult to comprehend for a lot of people. Your company is now bankrupt. Our economy is in a state of crisis. But you get to keep $480 million. I have a very basic question for you. Is this fair?